Good morning, Torbay. Wow, have we been having fun this morning? I didn't think that my 60s would start quite like they have. I was up for it, but the systems weren't. So it just shows there's life in the old dog yet. Thanks to Emily. Emily has been working behind the scenes since 8 o'clock to try and get us live. She's been onto the help desk, been on hold, and we have our wonderful guests today. We have Melinda Myers, Southwest agent for the Bank of England. We have Martin Rogers, who is the mastermind behind the fantastic hotel investment for the Fragrance Group. And we have Brendan Prince. I'm not going to say much, Brendan, but I think he is slightly mad because he is going to paddleboard around the UK in just a few weeks. So we're going to come to Brendan soon. Today we're talking economy, investment and human resilience. And I think our guests today are really going to show us that. So thank you to our 42 people who have stayed with us and stayed on the line. I'm so sorry we couldn't get in. We couldn't get in, you couldn't get in, but we're here now. The Business Forum, we couldn't be here if it wasn't for our wonderful sponsors. So thank you to our sponsors. And we have sponsors of the month are Big Wave Media and the TDA. So if I could just start, I'm going to cut to the quick because Melinda does have another meeting at 9:30. So we're going to get straight into the economic side. Now, the Bank of England was actually set up in, what was it, 1694, and it was set up to raise money to fund a war with France. Well, all I'd say that at the moment, we still seem to be fighting them. I'm not really sure whether we should be or not. Lindy, is Brexit the modern day version of what was it William and Mary did? But, I'm going to hand over to you because at the moment we talk about inflation, we talk about the cost to the economy of COVID, and we talk about negative interest rates. Tell us what the Bank of England sees.
Okay, thank you. I got up early to add in a slide on Brexit, but unfortunately that's not the one Emily's got, so we'll have to just talk around that. So I'm just going to do a very quick tour of sort of global financial conditions, UK financial conditions, the demand side and the supply side of the UK economy. And the reason I've broken it down into demand and supply is that inflation is kind of where those two things come together. And obviously COVID has affected both the demand side and the supply side. So the question mark for the MPC is how do those two things recover in tandem? And we think demand is going to pick up quite strongly over this year. But some of those supply disruptions may continue, and there's also some longer term supply constraints on the UK economy relating to Brexit and some structural unemployment issues and also weak investment. So really we want to see how those two things play out together going forwards. So if we could go on to the first slide, please, you see, so Emily. Yeah, thank you. So there's obviously been enormous amounts of fiscal and monetary stimulus around the world since the start of last year. In the left-hand chart, you can see the sort of government borrowing, i.e. the fiscal stimulus in the US, Euro area and China, and you can see how it's significantly higher than it was on average between 2010 and 2019 pre-COVID. And then on the right-hand side, you can see the monetary stimulus, both the Bank of England, but also the Fed and the ECB. And you can see particularly with the red line, the Bank of England, that the forward look, market expectations are, well, they were in February that there may be some negative interest rates going forwards, but I think that the risk of or chance of that has dissipated quite significantly in the last week or so. This is very much the bank saying, or the MPC saying, it needs to be in the toolbox and we need to make it operational if it's going to be in the toolkit. So that's why they've asked banks to prepare for it. But it's very much a kind of, there are other things they'd rather do before they venture into negative interest rates because there are a number of sort of operational complications with it and it can be slightly distorting on lending and deposits. So they'd much rather do other things first. And in fact, they put out some phrasing in this last letter of minutes about how they would unwind QE and interest rates, and they'd like to get interest rates up to a level where they could then cut if they needed to before they unwind QE. So in the same minutes, they're talking about preparing banks for operational negative interest rates, but they're also talking about how they will extract themselves from this very loose monetary position in the February report. So that just illustrates how wide the scope is of the economic outlook. We'll go on to the next one, please. So back in February, global financial markets were feeling a bit more resilient and a bit less cautious, and you can see the rally in what we call risky assets, i.e. equities, and the reduction in spreads on corporate bonds. So that means they're feeling less risky. They don't need so much spread to cover the risk. And that relates to a bunch of factors. So the vaccine means that the path out of COVID restrictions is in sight. There was a bit of uncertainty around the US election, which dissipated. And the global economies are looking as if they're starting to recover with all that monetary and fiscal stimulus. So a bunch of things mean that equity markets have rallied and corporate bond spreads have fallen, suggesting that there's a reduction in uncertainty and caution in global financial markets. Okay, next slide, please, which is about the UK credit conditions. And you can see in this chart here that credit conditions have tightened very slightly since November. Since November. So over the start of this year, the black line is going up very fractionally, and that's so there's been easing because of equity prices rallying. You can see the beige bars at the bottom, but also some slight tightening in mortgage spreads in the green bars. And if you click once more, we'll bring up the next chart on the right-hand side, which hopefully, yeah. So you can see their mortgage rates have increased, although they've flattened off more recently. So you can see the green bars in the left-hand chart are illustrating tightening in kind of credit conditions, but sort of plateauing. So the tightening in mortgage spreads is partly because of the economic outlook, but also banks' operational ability to meet demand has been quite constrained. Okay, next slide, please. Well, next got one. So, thank you. So this, so the left-hand chart here just shows you the path of GDP. Actually, in the fourth quarter, there's a slight increase of 0.6%, although that might well get revised with new data. And you can see the drop of about 4% in the first quarter of this year because of the national lockdown. Now, the national lockdown this time has had much smaller impact on GDP and activity because businesses and households have learned to adapt to the restrictions. For example, this time, just under 30% of businesses said they were paused for activity, whereas back in March, April, May time last year, it was a significantly higher proportion. So businesses have learned to operate around these restrictions and households have too. So the impact is much smaller this time around with the national lockdown. On the right-hand side, you can see the distribution of that impact. So the blue bars are household spending. And of course, the nature of COVID is that we're restricted in our social activity. So that's had the biggest impact on consumer services, which is primarily, household consumption. But business investment has also remained very weak. So it's about 20% below pre-COVID levels. And if you remember, 2018, 2019 was also fairly subdued time for business investment. So business investment is really quite weak at the moment. But we're hoping that will be part of the recovery phase because businesses are sitting on quite a bit of cash and borrowing. But investment from, the talk about investment from our contacts is that it's very much contingent on a lifting in uncertainty and caution. So businesses want to feel much more secure about the demand landscape before they start to invest and expand capacity. We'll go on to the next slide, please. I was just explaining that the impact of this lockdown has been much reduced. In the left-hand side, you can see mobility indicators, and whilst they dropped quite sharply in January, they didn't drop quite as far as they did back in April time. And on the right-hand side, you can see the blue bars, which is businesses that have paused trading at just under 30% in January this year, which is similar to where we were back in June, July last year. So, much fewer businesses have paused trading this time around. And on to the next one, please, which is our GDP fan chart. So here you can see that small increment in the fourth quarter, just sort of looks like a bit of a flat part of the dark green band, and then that drop in the first quarter of this year, but then a very strong recovery through the rest of this year. And we think we'll be back to pre-COVID levels by around the start of 2022. And the strength of that recovery is based on the fact that households have accumulated quite a lot of savings, although that's not evenly distributed, and some households really have suffered through this. But there's a lot of pent-up demand and savings to hopefully support that pent-up demand. And businesses are sitting on quite a lot of borrowing, particularly those government-backed credit schemes and some cash buffers. So we're hoping that those two things will come together and support growth in conjunction with very loose monetary policy and fiscal policy at the moment. So if we go on to the next chart, which illustrates the housing point, household savings, and the left-hand chart, you can see the blue line illustrates the drop in income on average. Some households have experienced a much bigger drop in income, but some households will hardly notice any drop in income. I think for many people on the call right now, we've all carried on working and our income hasn't really changed, but our spending has dropped considerably. So on average, household incomes, the blue line, haven't dropped as much as household consumption, the red line. And so you can see that beige swathe represents the accumulation of savings in households. And on the right-hand chart, you can see that accumulation month by month. And in fact, we just put out some new data on monthly savings and it's gone up again. So we think there's an accumulation of about 160 billion of household savings. But how that unwinds and how that's spent partly depends on the distribution across households. So if it's sitting in higher income households and retired households, they have a lower propensity to consume than lower income households. So it's not a kind of one-for-one, higher savings means higher consumption. If you go on to the next chart, please. It just illustrates sort of the expectation of the unwinding of COVID. I mean, admittedly, this was in early February when the vaccine was being rolled out quite successfully, but I think there's been more momentum since then, and we've had the, the rollout of the path to lifting restrictions announced by the PM. So you can see that whilst there's been an improvement in confidence about sort of exit from lockdown in the short term, the red panel, there are still quite a few houses who think it'll take 7 months to a year to return to normal life, the pink panel, and the blue panel, which is it'll take more than a year. So there is some reticence amongst households and consumers about how quickly they feel able to get back out into the marketplace and start spending their money and consuming. And then on to the next slide, please, which is about businesses. So this just illustrates the accumulation of borrowing through the government support schemes, but also some possible cash buffers accumulating. So on the left, it just shows you the tremendous acceleration in borrowing, particularly in the first few months of COVID restrictions and sort of the second quarter of 2020. Although there has been a bit of an acceleration in late 2020 in December, I think, from small businesses. So a lot of businesses seem to have borrowed under those credit schemes, but have just deposited. So they're not yet willing to use it for investment, although some have certainly used it to bridge cash positions in those most affected sectors like hospitality and tourism. And on the right, you can see that although sales dropped, the blue bars, investment dropped by more. So that's the red bars. And quite a few business contacts of mine say, although turnover's down, overheads are down by even more, so they've accumulated some margin. So some are sitting on cash buffers and some are sitting on quite a lot of credit. So once they feel more confident, hopefully they'll start investing. And that will help on the supply side as well as the demand side. So on the next, if you just go to the next but one slide, please. Yeah, perfect. So on the left, you can see kind of, well, it's a sentiment about investment intentions. So it's a sort of proxy for business confidence. And you can see that it has recovered quite nicely, that uptick at the right-hand side, but it's still well below pre-COVID levels. So businesses are still quite cautious, but they're very conscious that demand might pick up quite strongly. And how do they meet that demand when they've perhaps made some staff redundant, or some staff are still on furlough and they haven't invested for quite some time. So I'm starting to hear much more planning to invest to increase capacity over the coming year or so. And then on the right-hand side, it's just kind of another illustrator about how businesses are feeling about COVID uncertainty, sort of echoes that one on households. And you can see that in the early part of this year, this is a DMP survey, that whilst just under 40% of businesses think COVID uncertainty will have reduced by the end of this year, just under 40% still think it'll take well into 2022 before COVID uncertainty really kind of fades away. So there is still quite a lot of residual uncertainty amongst households and businesses about how things will play out. Albeit these surveys will happen before the PM's path out of restrictions. Okay, on to the next slide, please. I think we're moving on to the supply side of the economy, right? So I've just illustrated that the demand side is going to hopefully pick up pretty strongly. On the supply side, I've just illustrated that investment is fairly weak and has been for quite some time, and that affects productivity. And then here on the labour force side, we've struggled a bit to unpick what's going on with the data because the official labour force survey measurement of employment and unemployment has not really moved substantially. So employment has barely moved, as you can see in the blue line, but HMRC employee numbers has dropped quite substantially. So that's the red line, that's dropped by about 800,000. And the ONS workforce jobs measure has also dropped. And ONS have suggested that we should perhaps put more sway on those two measures than their official employment levels. So there's definitely been some rise in unemployment, and also people who have been made redundant have moved into inactivity as well because they feel it's not a good time to be looking for a job. And then on the right-hand side, you can see the rise in redundancy announcements through the middle of last year. Certainly July, August time, there was huge increases in redundancy announcements, and quite a few of those materialised into redundancies in the red line. But we think that's dropped back quite substantially, and a lot of businesses have done their right sizing by now, although there is some residual redundancy going on. And really the key there is how the JRS scheme is wound down in conjunction with demand picking up, demand and activity picking up. So if demand picks up quite quickly ahead of the JRS scheme unwinding, then we shouldn't see too much fallout in the labour market. But if the JRS scheme is stopped sooner rather than later, before activity gets going, then we may start to see some more redundancies going on. And we saw that play out kind of in the autumn when the JRS scheme extension wasn't announced quickly enough and businesses started to make redundancies. On the next slide, you can see that unemployment is rising. Yeah, in the left-hand side there, that's the unemployment rate, and the latest figure was 5.1. So that's significantly lower than we would expect given the drop in activity and output. And that's largely because of the job retention scheme that has sheltered a lot of jobs from being made, a lot of people from being made unemployed. However, in the right-hand side, you can see our fan chart, and we think it will rise quite sharply in the middle of this year. But it's very much contingent on what the government does with the job retention scheme and how quickly that demand picks up again. So you can see it rises quite fast to about 7.5 to 7.75%, but it also drops off quite quickly as well through 2021. So just some kind of frictional unemployment there, just as people move around and are unemployed but re-employed. But we think there'll be some residual structural unemployment going forwards. And you can see that the middle of that dark blue swathe takes quite a long time to get back to pre-COVID levels in the blue line on the left part of the chart. So, I kind of give this rather simplistic example of how people in hospitality, a waitress, say, you can't just jump over into those sectors that have been growing quite fast, say IT. So you can't turn a waitress into a software developer overnight. So there will be some structural unemployment because of the sectoral mix of where people are being made redundant and where employment's expanding. And then on the next slide, it gives you a bit of information about pay. And again, quite stark contrast between the official data in the left-hand chart, which shows average weekly earnings, and I think they're about 3–4%. And then on the right-hand side, you can see the diamonds represent the our agent survey of pay settlements, and the red line is a kind of measure of a range of private sector settlements. And you can see that the green diamond at the right-hand side, all respondents to our survey, on average, thought pay settlements this year would be about 2.2%, down from 2.5 last year. But over 1 in 4 pay settlements was being deferred this year. So a lot of absence of pay settlements this year. So pay pressures are very much down. But that left-hand chart is quite strong because of compositional effects. So those that are being made redundant tend to be quite low pay, and those who are staying in employment tend to be much higher skill and higher pay. So you've got a compositional thing going on there. And then in this next chart, I just bring some of that together on to illustrate inflation. That's it, thank you. So on the left, the dark blue line shows you headline inflation, and the pale blue line shows you inflation, but with the VAT cut and energy prices removed. So you can see the red bars going down are dragging on inflation. So the red bars are energy and the beige bars are the VAT cut. So you can see that there's some particular factors pulling down on inflation through 2020 and the early part of 21. And when those things start to come out of the calculation and reverse, we'll see quite a strong kick up in inflation. At the same time, weak demand through 2020 has also suppressed price activity. And we think that will start to pick up again as demand recovers. And there may be some supply constraints pushing up pricing. So on the right-hand side, you can see the fan chart with inflation recovering really quite fast and going above our 2% target for some of the forecast horizon before settling back down towards 2%. And that's it. My last slide just brings together those 3 fan charts. I think, sorry, just to mention, these fans are exceptionally wide, reflecting the very high levels of uncertainty at the moment on a number of fronts. Yeah, I could perhaps take 1 or 2 questions.
Yeah, I love the fan charts because it does show that variance in opinion, and I guess you just have to take the average of that in the end, don't you? And somebody has asked, it's an interesting question, and it is talked about on the news, is there really a magic money tree? Now, you could be talking about money tree policy here, I guess, but just my thoughts there, we're starting to hear vibes of rampant inflation and what's that going to do to the stock market. And on the other hand, we're talking about negative interest rates. How do you balance those 2 things?
Yeah, so I don't think it's any secret that within the MPC of 9 members, there's quite a wide range of views. So Andy Haldane, our chief economist, is very optimistic about the outlook, and he is quite concerned about inflation picking up because he thinks demand will recover very strongly through this year. And then at the other end, you've got a couple of the external members who are quite concerned about the recovery and needing to keep support in place. Because if you withdraw support, you can quickly spook the economy and agents in the economy and the markets, and you quickly go, back from where you come. So the MPC have said they don't want to unwind support until they feel the economy is well on the way to recovery and inflation is well on the way to getting back towards target. So they don't want to risk jeopardizing the recovery too soon. I mean, hopefully this is off the record and Chatham House rules, but my sense is they would rather go slightly above before they unwind support than do it too soon. And then they've also said in the minutes, as you just said, both talking about negative interest rates and making them operational, and then in the very next paragraph, they're talking about asking staff to look into the implications of unwinding that monetary support and how they would do that. And they would raise interest rates until they're at such a level they could still cut materially before they start to wind in QE, before they start to wind in quantitative easing. So, as you say, very wide ranges on monetary policy. And I think that's reflected around the world, to be honest. It's not just in the UK. Yeah.
Yeah, well, thank you for that. I mean, I know that we touched on briefly about the budget tomorrow, and I know that's not your bag, and I'm not going to ask you for any predictions, but it was interesting reading the fact that the type of money that the Chancellor could raise through corporation tax or income tax would be almost wiped out by a 1% increase in interest rates. So I imagine they are walking a fine tightrope.
Yeah, so at the moment, interest rates are very low. So the line is, now's the time to borrow, to invest, and all the rest of it. So interest rates, base rate affects the short-term curve, and QE affects the long-term part of the curve. So by reining in QE after they've raised interest rates, that would suggest that they want to keep longer-term interest rates lower for longer if they can. So they're trying to, keep things reasonably stable in the markets to support, to support some of the fiscal activity. I mean, interest rates are still historically low, and I know we all think 2% inflation seems rather heady at the moment, but 2% is actually still quite low on inflation. And interest rates are at 0.1, so even going up to 1% would still be pretty low by historic standards. I think dealing with debt, there's three real ways you can deal with it. One is to grow the economy. So not only do you bring in more tax revenues, but you also increase the denominator for the ratio. The other is to cut spending, and the other is to raise taxes in some form. So I imagine he'll be doing a mixture of all those three things, but particularly hoping that the economy accelerates and brings in some tax revenues over the coming year. But it does present an opportunity in a sense, because governments right around the world have given enormous fiscal support to their economies, and they've got to claw that back. So it's an opportunity in a way to do something a bit more radical with the tax system and rebalance it a bit, perhaps, rather than just sort of tinkering here and there with a percentage point here and there. It does give them opportunity to do something a bit more substantial. Now, for instance, I've read that some governments are the new American government and the European Commission are quite keen to do something on digital companies. So, it potentially galvanizes all these fiscal authorities to do something a bit more substantial on international tax as well as domestic tax.
Right. Okay, thank you. I know you've got to go in a minute, but Jonathan Cavanagh just posed a question saying, briefly, is the Brexit transition proving as smooth as the bank was previously suggesting?
Yeah, so where we are on Brexit is pretty consistent with what we'd anticipated in November. So we thought there'd be some short-term disruption, which we've seen, and it's possibly been exacerbated by some COVID factors. And then our medium-term expectations for the impact of Brexit remain in place. So we think there'll be about 1 percentage point knock to GDP because of some temporary disruption at the borders. And certainly there's some evidence that there is an increase in exports to and imports from the EU in Q4, and that's had an impact on Q1, dampening it. So there's some stock building. But it seems that flows of trade, certainly through Dover in January, have been lower than even normal for January. So it does seem that there's been a bit of disruption, and certainly kind of dealing with customs, rules of origin and regulatory checks has increased administrative costs for businesses. And freight difficulties, getting stuff in and out. It seems to have caused problems, particularly in the manufacturing sector, I would say. I've heard it less so in some other bits of the economy, but particularly manufacturing and some consumer goods aspects.
Yes, I mean, there's certainly some friction at the ports, talking to some of my exporters at least, and also people trying to get stock in as well. So we definitely, we're living in interesting times, as they always say.
Yes.
This story is going to continue unfolding. But I thought the Bank of England website's got.
One thing that's worth flagging is the deal that was settled upon is very goods orientated and it's very thin on services. So that's all still to play out, and we're seeing it before our eyes, the sort of flashing out of passporting equivalents, etc., etc. So I think there's quite a lot still to uncover on the services side as activity picks up through this year.
And particularly in financial services, as has been discussed recently. At Bank of England website, fascinating mine of information there. But because it was my birthday yesterday, just in case anybody hadn't noticed, and I turned 60, and I put into the Bank of England's inflation calculator that if I'd been given £1,000 on the 1st of March 1961, to have the same yesterday, I'd have had to given £22,764. So that is an average of 5.4% per year. But going back to the original formation of the Bank of England and raising money for that war, that 1.2 million that was raised in 1694 is actually only 239 million now. So it's only 1.6% per year. So obviously, the longer it goes on, inflation sort of balances out. Is that true?
Yeah, you don't really want to inflate away your debt. Ideally, you deal with your debt by increasing revenues, reducing spending, and growing the economy. But you do want a bit of inflation, so you don't want to be at zero because it's a bit close to negative deflation. So that's why many central banks have settled on 2 or thereabouts, because it's low, but it's positive. And you want a little bit of price activity in the economy. You don't want it to be zero. Equally, you don't want to be too high. And actually, inflation expectations seem quite well anchored at the moment. So in a sense, it's expectations that is more important than the here and now on inflation, because that tells you what households and businesses will be doing on their pricing strategies going forwards.
Yeah.
Okay, I'm going to shoot off, I'm afraid.
Yeah, I really do appreciate you hanging in with us today. It was an interesting hour, but thank you so much for your presentation today. These slides, this presentation will be available on our website, so thank you so much for coming today. I'll let you go off to your next meeting, and we look forward to seeing you again.
Sorry, if you're putting it on your website, could it not be forwarded, please?
It goes on to our website. Yeah. Thank you very much. Yep. Okay.
Happy birthday. Bye, everybody.
Thank you. Goodbye.
Thank you.
How do I come out?
Emily can find the door for you. That's well done, Emily. So thank you so much. So we're having so much fun this morning. This is really, really, really good. So Brendan and Martin, thank you for I'm now going to quiz you on all of that, be answer your test before you leave. But it is interesting, sort of the sentiment now as we're going forward, and that actually the signs are definitely positive. There's been more than just green shoots coming, and the daffodils are out, and mine is shoot, as you can see. Martin, we've been talking there about business investment. And I think if anybody knows about business investment at the moment, it's you there with the checkbook. So can you tell us how the last 12 months have impacted on your business and the fragrance group? And since we stood there at the Riviera Centre, face to face, with your hands around my throat, saying, I'm going to kill you, Reynolds. I'm still here. Over to you.
Is my microphone working?
Yes, it is. We can hear you loud and clear.
Okay, that's the first thing. Thank you for inviting me again. The last time you invited me, I got a free breakfast. Obviously, that's not today. So,
Sorry about
I remember one thing today, that you were born in 1694. So I'll remember
That's
that. Yeah, what a difference a year makes. Within that year, fragrance around the world, I'll just pick up on first. We opened a 464 bedroom Novotel in Perth. We've just opened a Movenpick in Hobart. We're about to open a Movenpick in Melbourne. And Mr. Coe has started to build a 1,000-bedroom hotel in Singapore, a great big skyscraper. So he's carrying on building around the world at the moment. The other interesting thing globally is that the pandemic always brings somebody good news. And 17 of our 23 hotels in Singapore have been used by the government. The Novotel in Perth has been leased by the government and is still being used for people who are arriving into Perth from outside to stay, similar to the ones we're doing in the UK now, and similarly the one in Hobart. Turning to locally, this time last year we had just started to build the Park Hotel, which is 164 Mercure, and I'm sure that anybody locally will have seen that we are one story below the top story now. So by the end of April, we should be putting the roof on the whole of the building, so we'll be completely watertight. We were due to finish the Mercure originally in October, so we're behind. I think that there's a number of reasons for being behind. COVID is one of them. Ground conditions is a big player. If you remember what the weather was like in the early part of last year, very similar to this year, it was unbelievably wet. And the guys trying to do the foundations to the park were paddling around up to their waist in water and mud every time the tide came in. But we have started to catch up. The Mercure, the date for opening is probably going to be around February next year. And for the lighthouse, which this time last year we just finished demolishing, is probably going to be around April next year. So we're probably about 4 months behind on both projects. And the lighthouse, the former lighthouse, you remember, is going to be an Ibis Styles. Both of them are going to be operated and run by Accor, which is the brand. And of interest to the people of Torbay is that the company will start recruiting for the staffing of both hotels probably in October. So the general manager will be appointed probably in September, and then he and the HR team at Accor will be starting to look at key appointments through the next few months, and then after Christmas at the rest of the staff employment. The Corbin Head Hotel, this time last year we'd just started to demolish it, is now obviously completely demolished. We are in the process of negotiating with a contractor at the moment to sign a contract. Somebody will be going on site to do some further investigation works of the ground conditions within a week, and my best estimate is that we will have signed a contract and a contractor will be on site by the summer. So the completion date for the Corbin Head will probably be the summer of 23. 152 beds. I can't tell you which brand it is that's going in there, but it's exciting. I haven't signed the terms as yet, but we're not very far away from doing that. Out of interest, we started to build our 5-star 186 bedroom end gallery in Liverpool in October. So the amount of investment into hotels in the UK is amazing at the moment from the Fragrance Group. We've had some difficulties this year. In addition to the development sites, we have 6 trading hotels in the UK. 4 of those trading hotels are under lease to a company called Bespoke Hotels, who were also the operators of the Shearings Group last year. They went into liquidation 3 weeks ago, and the local one is the Duke of Cornwall in Plymouth. We stepped in very quick, and within 2 weeks of Bespoke closing it, or the liquidator closing it, we put a new management team in last Monday, and we've re-employed the general manager, and we're re-employing staff there immediately. So that should be ready to be open when the government lets us open hotels again.
Yeah, it was a nice news headline on the evening news. It was good to see that happen on the Duke of Cornwall.
Yeah, so we stepped in pretty quick there. One thing that Melindy said about that was interesting is that Brexit is affecting us as well. Brexit is affecting the contractor, because so much of what you build buildings with comes from Europe. Tiles from Italy, for instance. So much is coming from out of, or being difficult to get out of Europe, and that is affecting the way in which we are going to be building and furnishing that hotel, that we're going to have to look at different markets to import into the UK. A lot of it we can't get in the UK. Where we can, obviously we are, because it's easier to do it that way. But Brexit is definitely going to have an effect.
I know that cost of insulation is going up something like 25% in March and April.
Yeah.
Yeah, there's some definite supply and demand pools there. So, and tell us what's happening over at the Palace then. Rather smart.
We've got the Palace. So the Palace, it took us 4.5 months longer than we'd anticipated to knock it down, primarily because of the amount of asbestos we found in the building. You probably saw on Jim Parker's paper that it's down. We now have a cleared site. The demolition contractor handed it back to me last week. And we've started to, first of all, look at the residential site, where we are understanding how to build the housing there, because you get a planning consent and then you've got to try and understand how to actually build it. And the hotel is the next in line to be looked at. Mr. Coe is going to be coming here, we hope, in the summer, and his primary reason for coming over obviously is to see his hotels in Paynton and the progress, but also to look at the Palace Hotel and to decide exactly how we're going to build that. It's a very big project and a very complicated one to build.
Wow, I mean, it is a fascinating project, do you think? And when would you see the Palace being open then?
The Palace, 2024,
yeah.
2024.
Yeah, yeah. And that's pretty much what you said to us 12 months ago. So I'd like to say you're on schedule. Well done.
There's only me in the UK, and I can only do things in a year.
Well, I'm suggesting you need to get that hard hat on and get out there with your hammer and your digger and get building. So, but Martin, we really appreciate you coming on today and giving us an update. It's not quite the same without the breakfast, I know, but with the roadmap in place now, and I think the feeling of positivity that there is in the air, people are a little bit nervous about it, but it's getting more positive. And I think we will be back having breakfast in the not too distant future. So we're really looking forward to seeing that roadmap lay out.
Torbay Business Forum, March 2022 at the Mercure in Paynton.
I think that's a deal. Yeah.
Yep.
Look forward to that one. Get that in your diary, folks, and really look forward to seeing that happen. That'll be fantastic. Get the sausages on order. So thank you, Martin. Just a reminder, folks, you can post a question there's a questions panel. You can pass one on, but we'll leave Martin for the moment now and give him a chance to take a breath as he thinks about his recruitment program that's coming up in October. And now, human resilience. Brendan, our very own resident action man. Last time I saw you, Brendan, you were paddling into Torbay Sands, having come from Sennen Cove. Whatever possessed you to think you wanted to do it again?
You'd think I'd know better, wouldn't you? Thank you, Stephen. Thank you. Good morning, everybody. I think probably best, actually, Emily, I don't know if you can show the video.
Yeah,
I don't know if that worked this morning, but if you want to give that a go.
I think I can, Brendan. We'll give it a go anyway.
Give it a try. The Long Paddle 2021 is a circumnavigation of mainland Britain by stand-up paddleboard. It has been attempted quite a few times but never actually been achieved. So that is somebody paddling around the whole of the mainland coastline, which is obviously England, Wales, Scotland. It works at about 3,500 kilometres, so it's a fair old way. And if I achieve it, I'll be setting 3 world records, which is the circumnavigation, which will be the first time that record's ever been set. It will also be the time from Land's End to John O'Groats as a kind of a race pace, and also the furthest ever journey by SUP at 3,500, give or take a few hundred kilometres here and there. My name is Brendan Prince, and this year 2021 I will be paddling around Great Britain. So yeah, I'm called crazy by lots of different people, but if I actually give you a bit of reason behind why I've chosen to do this, I think it might explain and make a bit more sense. So first of all, my name is Brendan Prince, and I've lived and worked in Torbay for 25 years as head of outdoor education at the Boys Grammar School, the local school, on the water pretty much every day in those 25 years. So I'm a waterman at heart. Now, if I just give you some facts that some people may or may not know, that 320,000 people drown on this planet every year, 700 drown in this country every year, and a child drowns every week in this country. I am still a lifeguard, but I was an off-duty lifeguard 5 years ago, and I witnessed and tried to save 3 people who drowned in front of me. That was a particularly catastrophic event in my life because each of those 3 people had all their families there watching. And when I mean families, I mean aunties, uncles, children, grandchildren, cousins. They were all there. And I realized just what a catastrophic event it was. So from that moment, really, I kind of changed my life. I upped the game of the amount of water safety that I was putting out there within schools, visiting schools all up and down the country. And in fact, a couple of years ago, I gave up teaching to just do this 100% of my time, to share this water safety message. But I realized that actually I was only hitting so many people around this country, and what could I do to up the game to get the water safety message into a house in Coventry, into a house in Brighton, into a house in Norfolk. So I kind of put the 2 things together, which is my desire and motivation to teach water safety and my ability to be able to paddleboard. And I've been paddling boarding for almost 15 years. So I came up with the idea of going around this fabulous country on paddleboard. And since announcing that I was going to do this, I'm doing 10 interviews a day, from the BBC, Red Bull TV, through to all the TV channels. I'm doing radio stations in Australia. It's quite astounding how the media seem to be latching on to this. And consequently, if you're trying to raise money for anything now, you've got to do something a little bit bigger and better, so that people will put their hand in their pocket and donate. And the reason, obviously, I'm doing this amazing challenge is to spread the water safety message. But what does that mean? Well, it means that I'm hoping to raise £200,000, £100,000 to actually create an app that children can play, a game on their phone that children can play, that will teach them about water safety. That's something that is not available anywhere on planet Earth. Can you imagine a child going to Torbay Sands, and before they go to Torbay Sands, they play the Torbay Sands game, which tells them about the water conditions, tells them about the tide, the weather at Torbay Sands. It's a totally unique thing. I'm getting lots of corporate investment into that app because it will cost about £250,000 to put together, but I still need about 100,000 to do that. So that's kind of the motivation behind why I'm doing, but I'm spreading the love as well because I'm hoping to double my money and get another 100,000 to help the charities around our coastline that really need it, the RLNI, Surf Life Saving GB, my own charity that I volunteer for, Above Water. But also in these times, I think I need to show a bit of understanding to men's health. So I'll be helping some men's health charities, and also doing something like this, I'm going to see the coastline like never before, and I'll actually be witnessing firsthand some of the impacts humans have. So I'll be supporting Surf Kids Against Sewage as an obvious charity to do. Now, as Stephen suggested earlier, I have in fact paddleboarded and swam the coast of Cornwall, Devon, Dorset, and Somerset. And Torbay is an absolute oasis in that. And I know that firsthand because I've seen all those places. I'm hoping by circumnavigating the whole country, I will still think that Torbay is an oasis for so many reasons, so many water-based reasons. So that's basically me. I'm, of course, in this endeavor needing commercial sponsorship. We've got many unique opportunities for that. But just to share the message around the country, come and visit when I set off on the 24th of April, and follow me, and hopefully come and cheer me on when I'm coming back into the bay within 90 days of setting off. Thank you very much for your time. I really appreciate you listening.
Well, that's great. And I know that Martin's got to dash off, but just to recap there, it's a £250,000 ask in total, is that right?
Yes, I'm hoping to gain 200,000, 100,000 for this gap for children to be able to play, and then 100,000 for all the different water safety charities.
Yeah, okay, that's fantastic. And we can certainly, through the forum, we can help spread the word. And any corporate investors looking on, anybody, how can they get in touch then, did you say, Brendan? Just give us a reminder as to how to get in touch.
We've got the website is thelongpaddle2021.com, and on all the social media channels as the Long Paddle 2021. So just give me a bell or one of my team, and we'll sort something out. But yeah, there are lots of opportunities there for supporting and being part of something that which could be history.
Brendan, can I just say that I wish you all the luck. My nephew paddled road around Great Britain about 4 years ago on a boat called Savoir-Faire. So I know how hard it was rowing. On a paddleboard, it'd just be unbelievably difficult. So I wish you all the luck. Thank you, Martin. I appreciate that.
Yeah. Well, great. And through our network, let's help you, support you. What date do you set paddle? Do you just set sail?
Yeah, hoping, sail would be nice. Hoping to set off on the 24th of April, but that does depend on a good weather window that week to start off, but around the end of April.
So about the 24th. And Martin, you've got to go. So thank you for joining us today. Really appreciate it. It's great to see the investment that's coming in. Thank you for what you're doing. And I've just had a pledge in, £100 from David Rowe, one of our sponsors. So thank you, David. So you got £100 better off today, Brendan. And I'm sure there's going to be much more coming your way.
Well worth it. Thank you.
So Martin, I'll let you drop out when you need to go because you've got a meeting at 10. So thank you. Emily, if you're still there, do you want to join us on screen? and then we'll just say our goodbyes. It's been smooth today, hasn't it? Well done, Em. You've done really well to keep us here. You've been on the phone to the help desk and you've been on hold. So, but thank you for wrestling it through, and thank you to all the people that stayed with us today. Of course, the playback of this event will be on our website. And anybody that wants to support Brendan, please do get in touch. Em, have you got the sponsors slides there? I've got a different screen on mine. I don't know, maybe it's just my screen.
I do, Steve. Hopefully everybody can see it.
As long as everybody else can see it, then that's fine. I just want to say thank you to our sponsors again. Thank you to Big Wave, who provided the great background slide for Emily. Their GoToWebinar wouldn't let me have one of those as well, so we've got bubbles on mine. So why not? I like bubbles, especially in lockdown. Next event will be the Torbay Business and Chambers Network on the 16th of March. So please do join in that. That one's via Zoom. Thanks to Dean at Painter and Chamber of Commerce for organising that. Thank you also to, so I said to Big Wave, and also to the TDA who are sponsoring today's event. So thank you for that. Our next event will be in April. It does clash with Easter, so we might just slide the date a week there. But we're going to do a mental health special on that one, because there's just so much has been going on about the economy and money and issues, but what about the human factor behind this? So we're going to be doing a special on that. Thank you to Emily for bringing us through this today. Thank you to everybody for joining in. Thanks to Angela and IMS Marketing for doing all the fan outs and the e-shots. I think it's time to call it a close for today. We got through. Thank you, everybody, and have a great week. Bye for now.
Thanks, everyone. Thank you.
Thanks, everybody.
Bye, everyone.
Bye now.